Happy 2026, everyone. If you're watching this, you probably have a high net worth, high income, and very little time. Today, I'm opening up my books and showing you exactly how I'm positioning my portfolio to make 2026 a fantastic year. We're not just trying to grow, we're trying to optimize. I have 3 moves, and I'm going to show you the actual math behind them all. So let's talk about move number 1. The Golden Goose. I'm maxing out my retirement plans on day 1, but the real needle mover is my after-tax brokerage account. So let's dive right in. So if we start looking at my paycheck for the year, what you'll see here is that in the first month of the year, I made about $163,000. I make about $2 million a year. Now from that, I got to pay federal, Social Security, Medicare, and then also Michigan income tax. Now, all those together are $62,000. That's a huge, huge chunk of my paycheck. A lot of people, when they see I make this kind of money, they think, oh, okay, well, you're going to be rolling in it. It's actually quite hard to keep that much money because everybody's got their hands in it. The second part of this is, again, knowing that I'm going to be paying high taxes. I'm not stupid. I want to try to minimize my taxes as much as possible. So I'm going to be fully maxing out my retirement plans. And what you can see here is I've got my pre-tax 401k. Now my pre-tax 401k is the portion of money that I can put in that is before tax. So it's going to come right off my 37% tax bracket. So by putting in that $24,500, you can think of it as I'm saving about 8 to 9 grand in taxes just by doing it. Okay. But number 2, we have an after-tax option within our 401k plan. This is sometimes referred to as the Mega Backdoor Roth 401k. I know that's a mouthful, but here's what it really means. It allows me to put in much more into my 401k plan than a traditional 401k plan. Up to $72,000 a year, which includes the $24,500. Then it includes another $30,000+ that I can put in after tax, which I will convert to Roth. And then it also includes the 4% company match that I'm going to be getting, which I'll show you in a second. From there, my after-tax medical cost sharing is a plan that I use in lieu of health insurance. Now, the last thing that I'll show you is obviously, I've been putting in a lot of money into my 401k plan, but now my company also is giving me a large percentage of that match. Now, I didn't get all of it in this month, but you'll see actually when I show you next month, I'll get the rest of it, which is pretty amazing because in this case, then I've not just got my money working for the full year, but now I've got the company's money. So anyway, that's my first month, my first paycheck. The reason why I think it's important to build the Golden Goose is the Golden Goose lays golden eggs and we can eat the eggs, right? We can enjoy the eggs. That's like the dividends, the interest, the capital gains that come off of the account. I can use those as a secondary income source for myself. If I don't need the income, I can just reinvest it. But if I do need the income, I can use it to pay for a vacation. I can use it to improve my house. I can use it for pretty much anything. And at some point, if you build up the Golden Goose enough, what you're going to notice is that you're going to have so much money that eventually the money that's coming off the Golden Goose is more than what you can earn in your paycheck at your job. And guess what that's called? That's called being job optional or retirement ready. And it's a fantastic place to be. One of my former colleagues that worked at Verde, I remember him telling me this one day where he said, Carl, I make more money in a month in my investment account than you pay me in a year. Isn't that amazing? You being able to go up to your boss and say that? And it's true, right? In his case, he was able to essentially accumulate so much wealth in his brokerage account that he didn't need his job. His job became this hobby, and he kept it for as long as it suited him. But once he was ready to kind of spend more time golfing, hanging out with his grandkids, it was all about him having the option to do whatever he wanted to do. So that was fantastic. Move number 2 is about debt efficiency. I own a building in Clarkson, and it's fully stabilized at this point. What does that mean? It's 100% rented. I think that's a great time for me to think about refinancing my building because at this point, it will have its maximum value. So let's just talk about it for a second. The building is likely worth somewhere between $7.5 and $8.5 million. Based off of what I'd like to borrow, I don't want to be leveraged too much. So I'm going to keep the loan at a 70% LTV. What does that mean? I'm going to roughly take out $5.5 million as a loan. But here's the kicker. I'm not going to be using a fixed rate. I expect that the Federal Reserve will continue to lower interest rates, and I don't want to lock in the rate at this point. I just want to do the refinance at this point because I believe this is the point at which my building will be worth the most, at least for a while, right? So because I plan on doing that, and because I plan on holding the debt for no more than about 5 years, a variable rate to me makes sense. If I'm taking a $5.5 million loan, take a look at my screen now, and what you're going to notice is I'm going to my Verde client portal. Now, my Verde money portal is the thing that I use to manage my wealth. So here I can see my cash position, my credit cards, taxable accounts, And really what we're talking about today is my loans, my debt. And you can see I have about $3.9 million worth of debt. Now, why am I taking out $5.5 million if I have $3.9 million? Well, because in this case, I'm not only going to be paying off my debt, but I also have some leverage on one of my investment portfolios, and I'm going to be paying that down as well. And I want some extra money that I can actually put into the stock market. I'm super excited about AI and some of the things happening in the stock market right now. And I think it's a fantastic time to invest. So what I'm going to be doing is taking all of these loans that you see here, a business loan for $87,000, another loan for $87,000, another loan for $100,000, a land contract for $46,000, a mortgage for $127,000, another one for $293,000. You see them all, right? It's kind of hard to keep track of all of these loans, all of these separate payments. They're all on different amortization schedules. I want to just simplify right now and focus on just one debt. Not to mention that some of these debts I got a couple of years ago when interest rates were much, much higher than they are today. So for example, let's click on this loan. This is a mortgage on a rental property that I have. If I'm looking at this mortgage, I can see that this mortgage is at 7.625%. Well, that's a punitive rate. I don't want to keep that mortgage, right? So by refinancing, I'll probably be refinancing with the same company that right now has my my current mortgage on the building, which is down to about 1.5 million. So again, we'll have to pay that off. But if I'm looking at that rate, right, and I can kind of negotiate maybe something similar to what I'm paying now, that rate right here is 6.25%. Okay, so I'm already going to save some money right off the top. And if that's a variable rate and it's tied to something like LIBOR or maybe Fed funds, then as the Fed continues to lower interest rates, I'm going to get a break on that as well, which I'm super geeked out about, right? So again, it's going to simplify things for me. I'm going to make a fixed monthly payment. My goal is to try to get this loan done in probably 5 to 10 years, right? So it's going to have to be a lot of money that I'm putting towards it, somewhere between $50,000 and $100,000 a month. But the cash flow from the building can support easily that payment. And again, I don't want a lot of money tied up in this building right now, because if the building makes me money, I get to pay taxes on it at 37%. Okay. If the building, let's say, breaks even, but I have more money that I can invest in the stock market, when I take money out of the stock market, I pay little to no tax. At most, I'm paying 20% capital gains. But again, as you'll see in these videos, I never sell anything. I usually borrow against my account, which means I pay nothing in taxes when I make money in the stock market. So we've talked about step number 1, which was the asset side of things. We talked about step number 2, which is the debt side of things. Let's talk about step number 3. Step number 3 is all about resiliency. Now, what do I mean by that? I've been trying to do something for many, many years that I thought was a fantastic idea, but I've just been procrastinating. But this year is the year to do it, and I'll tell you exactly why. This year is the year that I'm putting solar panels on the roof of the building. I know some of you are going to look at this and be like, Carl, solar panels in Michigan, really? Like, that doesn't make any sense. But I've been watching something that's been happening for a long, long time, and it just continues to creep up on me. Every month I'm paying a little bit more in my utility bills, not just at home, but at work as well. So let's go through that for just a second. I want to show you guys a site that I'm super geeked about called Trueflation. Trueflation is actually a website that I found during the government shutdown. And what I love about this site was Trueflation is a website that tries to measure the same thing as the consumer price index, but instead of looking at 80,000 different items, it looks at millions of items by just screen scraping off of different websites like Amazon.com, Walmart, Zillow, Tesla, like anybody that puts their things online, which of course every retailer does now. You can screen scrape that data. So what's cool about Trueflation is I can look and see that actually the real inflation right now in the country is very, very low, 0.74%. That's much lower than what the government's reporting. Now, why is that important? Well, because if the Bureau of Labor Statistics is what the Fed's watching, and they tend to be following Trueflation, meaning look at this right here, the green line tends to follow the blue line, right? What I know is the green line is probably going to come down. And if the Fed is not really worried about inflation anymore, they're going to focus more on total employment, which means they're probably going to bring interest rates down. Now, in addition to this, I want to show you something else too. Within inflation, there are different categories: food and beverages, which are actually going down in price right now. Housing, again, going down in value, okay? One thing that's not going down is utilities, right? So if you look at utilities, the inflation rate on utilities has hovered somewhere around the 4% range if you kind of look at the average. But I'd say now with AI and the AI infrastructure, we've seen inflation rates as high as 10%, 13% year over year. Okay. This is by far, I think, the biggest opportunity for most people that they're not looking at. Okay. When thinking about investing, I want you guys to stop thinking about the dumb things. Hey, should I buy some gold right now? I hear that the price is high. That's rear view mirror investing. We're looking at the rear view mirror and we're just saying, hey, what's done well? Let's just buy into that. Now, this isn't a knock on gold and telling you don't buy gold ever. You can go buy gold if you want to, but gold does not produce anything. Gold does not have return on invested capital, and gold certainly does not pay you a dividend. Okay. Buy solar panels. Okay. When you buy solar panels and you put them on the roof of your house, there's a couple of things that are going to happen. Number one, you're going to get electricity, which is going to offset some of your costs. So even though, again, I've been procrastinating on this, I'll tell you why this is the year to do it. So for that, let's go to this solar quote that I got recently. Okay. Now, this is actually from a company that I use in this area called the Green Panel. And they've done solar panel installations, as you can see from this. This is the exact project summary from my building. So it's going to cost about $251,000 for these solar panels. Do you see that line below it? Total incentives, $139,000. What is that exactly? Well, because this is a commercial building and solar panels are still able to get the 30% tax credit until June of this year, as long as I start and pay for this project before June 30th of this year, I'll be able to take a 30% tax credit on those solar panels. Also, these solar panels, I don't know if you noticed, are made by Tesla. And because Tesla manufactures these solar panels in the United States, there's an additional 10% credit. So now we're talking about 40% of that comes back to me in the form of a credit, not a deduction, a credit. It's a big deal because let's say I have a $100,000 credit and I owe $100,000 in taxes, it wipes it out completely. Okay. Now, in addition to this, you can look at this and you can see, okay, I'm paying this cost up front, but what am I going to get? Well, I'm now avoiding some of my electric bill. My electric bill on this building is anywhere from $30,000 to $50,000 a year. And by putting up these solar panels, I'll be saving roughly half of that. And what you could see here is that every single year, the solar panels will pay for some of that electricity usage. And by the 6th year, I'm basically going to have these things paid off. And from that point on, I'm making money on the solar panels. Now, there's one additional thing that's happening this year that I think is kind of an amazing thing. I can actually write off the entire project as an expense this year. That is because of the One Big Beautiful Bill Act. The One Big Beautiful Bill Act allowed for CapEx projects, so capital expenditures, to be written off entirely. Normally, you could only write off a project over its useful life. So let's say I do an addition, I get to write off a portion every year in the form of a depreciation expense. But for the next couple of years, you can write off the whole thing. What does that mean? Let's say, for example, I spent $251,000 on this project, and after all the incentives, I end up paying about $150,000. And if I can take all of that as an expense against my revenue, it'll offset $150,000 of my income. And you know what my tax rate is, right? My tax rate's 37%. So that $150,000 will lower my taxes by about $50,000, $60,000, give or take. So this is why this is a must this year. So there you have it. The 3 things that I'm doing, take it or leave it. You can copy these things. You could say, well, Carl, I love these ideas. So I'm going to go take them, do them myself. I'm sharing this because I believe in transparency. You could take this outline to your CPA today, to your financial advisor today, and copy it. But I also know many of you in my audience, your time is more valuable than your labor. And if you want the same institutional grade asset management that I use to manage my own portfolio, reach out to a Verde advisor. We do this for a living so that you can live your life. Also, comment below, like this video if you enjoy this kind of content, and tell me what are the 3 things you're doing this year that are going to optimize your year and make 2026 your best financial year ever. We'll see you in the next video.